Hi guys, my name is Mike Boyd, this is the Money Flare, and I just wanted to make a quick video today just to talk about something that's been on my mind for the past couple of days as I've been going through YouTube, all these other personal finance channels, and seeing what they've been talking about and see what people in the comments have been talking about, certain stocks that they've been talking about. And I think it was sort of an important point to bring up, so I figured I'd make a quick video and just to talk about it. So I'm going to share my screen just to give you guys an idea of what I'm talking about. So let's say I go on YouTube and I just search up stocks or something like that. And if we just go through, here we go. So people talking about here Tesla, this was 43 minutes ago, Tesla stock. What else do we see here? FANGs, so Facebook, Apple, Tesla, Microsoft, Google. NEO, that's another one I see all the time. NEO. This one is saying the stock's gonna go up 8,000% this year, so definitely buy it now. Anyway, the idea is that also, I don't know why everyone seems so surprised in their thumbnails. Wow, like he's super surprised. The idea is that a lot of these YouTube channels that talk about personal finance and stocks, they all talk about the same types of stocks. They all generally talk about, and I mentioned this in my first video that I made, they all generally talk about tech stocks and growth stocks, particularly the unprofitable growth stocks. I was going through these videos and I saw people in the comments talking about how they're buying up these stocks because over the past few weeks, or ever since February, so let's say a month and a half now, these stocks have really taken a tumble. They've taken a huge hit. Some of them are down 30, 40, 50%. And a lot of people are saying that probably good buying opportunities now. And so I've seen people talking about picking up stocks like NEO and Tesla and all these other unprofitable growth stocks. And I wanted to make a video basically telling everyone, first of all, in my opinion, not to buy these stocks right now. So even though they've fallen a lot, I do not think this is a good point to buy them, and I think they could definitely fall further, and to be careful. And it's not really a surprise either why a lot of these YouTube channels sort of congregated to this basket of stocks, because they did really well over the past few months after COVID. And I'll just pull up the chart. Let's take a look at Tesla, for example. Tesla did phenomenal in 2020 after the pandemic. It went up, somewhere like 840, 835%, maybe even higher from the bottom. But basically Tesla just shot up like a rocket. A lot of these other stocks as well. Let's see, NEO. It's another one. This is sort of an electric vehicle company in China. Similar idea to Tesla. It also went up a lot after COVID. This one went up 1,800%. So it makes sense. These people that were buying these stocks, they made a lot of money since they started buying them. And a lot of people actually started investing in the stock market after the pandemic because they were at home, they had nothing better to do. And so they decided to essentially gamble on the stock market. And a lot of them that started doing that last year, they made a lot of money buying these unprofitable growth stocks. So I'll give you that. They did phenomenally well. If they were able to sell in February, they did really well. So why do I think these types of growth stocks did so well following the pandemic over the past few months? I think there's a few factors at play here. One of the biggest ones was obviously the pandemic in multiple ways, but firstly the pandemic in terms of how it was a real shock to the economy and people were concerned about future growth, future economic growth. They thought that the economies all around the world did shut down. So there was valid points or valid concerns regarding whether or not there would be, long-term solvency issues with companies going bankrupt. So it was a large shock. And whenever there is an event or whenever we're in an environment where people expect very low economic growth, they flock to growth stocks, because in an environment with very little growth, people want to own parts of the economy that are growing. So parts of the economy that may not be making money right now, like Tesla or like NIO, companies that are unprofitable currently, but are expected to be profitable in the future. And so they flock to those stocks and they pay any price for them. And I think that's partly why we saw this behavior following COVID. And that brings me sort of to the second point, or the second main reason why I believe these stocks, particularly the unprofitable growth stocks like Tesla, Palantir, NIO, why I believe they did so well over the past few months is that people were sitting at home doing nothing during COVID. They couldn't spend money going out. They couldn't spend money, getting a beer or going to a restaurant with friends. It was just a very different time for a lot of us during the pandemic. We were stuck at home. And it's not surprising that what people did with their money, especially what people did with the checks they were receiving from the government, was they gambled in the stock market. Not only were they gambling in the stock market, but they were also getting into the options market. And options are a complex topic that I want to dedicate to a full video, so I don't want to really confuse anyone with all the terminology and stuff. But just to sort of give a brief description of what they are, is they're financial products that you can buy that move in response to a stock's price movement. So if I were to bet, let's say that, or I can just use Apple as an example. Let's say I were to bet that Apple stock is gonna go up to $127 by a certain date, so by the expiration date, and that's key for options. In options, there are really two main components that you have to know about. Is that there is a strike price or a target price, so the price that you believe a stock is going to go to, and there's an expiration date. So you're making basically a timed bet. You're saying, I believe, so in this case, for example, let's say I say that Apple is going to go to $128 by May 21st. And so I can buy that option now when Apple's at 123. And if Apple does go up to 128, and even if it goes higher than 128, that call option multiplies in value significantly. So that option, so in this case, if Apple does go to 128, it's going up roughly 4%. But if I buy a call option and it actually goes in my favor, that call option might go up 100, 200%, where Apple's only going up 4%. So you're using a lot of leverage with options. And the same thing in reverse. There's also something called a put option, which is the same bet, but in reverse, where you're betting a stock is going to go down. So basically what an option is just a levered financial product that's tied to a stock, a certain stock. And what people were doing in sort of the whole pandemic months is that they were buying a lot of these call options. They were betting that stocks were going to go up, particularly these growth stocks like Tesla, NIO, Palantir, as I mentioned before, these high growth, unprofitable growth stocks. People were buying a lot of call options in these stocks. The call option volumes were something we've never seen before in markets, the amount of people buying call options. And it was coming from a lot of these smaller accounts. It wasn't really the big hedge funds or the people who, sort of the knowledgeable investors. It was really coming from first-time investors who didn't really know much about stocks or options, but like I said, we're gambling in the market. And so the other thing about options is that the way options work is there's always someone else on the other side of that bet. So when I'm buying an option, someone's selling me that option, and most likely it's something that it's someone that we would call a market maker. So it's a big institution like a bank or some other dedicated market makers who are selling that option to me. The whole point of a market maker is to provide liquidity to the market and to make their money on sort of the spread, the bid-ask spread. So what people are asking to buy, the price that they're asking to buy, and the price people are asking to sell. They often take advantage of those spreads, of that small change in price. And so they're really trying to make just profits on the act of providing liquidity to the market. And so they're not looking to bet that Apple is going to go down. They're looking to just provide liquidity. So I want to buy an option. They're looking to just sell that to me and then hedge. And what they do when they hedge, when they sell, let's say, a call option, is they buy the stock. If they sell me a call option that goes up a lot in value and then I sell it back and they buy it from me, they've lost money there. But if they buy Apple stock at the same time that they sell the option to me, then they don't really lose that much money, because If the price of Apple goes up, then they make money off of that stock. So what this does is it affects the price more than you would think, especially in this environment where, as I mentioned in my previous video, there's very little liquidity, and especially in the options market, there's a lot of volume going on in options. So people are buying a lot of options, and these market makers, these dealers, are hedging all of those options, and so they're buying up all these stocks. So it creates sort of a feedback effect where people on Wall Street Bets are talking about Tesla, they're buying call options. The market makers, the dealers, are selling those call options to them, but then they're buying the stock, which brings the price up. And then when these people make money off of those call options, those people on Wall Street Bets, they sell, they buy more, the dealers hedge more. It just creates this feedback loop where the price keeps going higher and higher. There's a lot more going on with options, and I don't really want to get too in detail, but that's basically the sort of general view of how options affect the price. So basically, just to get back to the whole point of this video, the reason why these growth stocks were going up so much in those pandemic months is, firstly, people were stuck at home, firstly, economic growth was really affected. So people rushed to these growth stocks when that sort of thing happens. Secondly, people were stuck at home and were gambling on the stock market, especially gambling on options. And third, the sort of nature of the market now with the low liquidity and this effect of options really affecting or really creating this large effect on the underlying price of the stock. All those three are major reasons why there was sort of a mini bubble in these growth stocks leading up to just a month ago. And so that is the environment that you want to buy growth stocks in. You want to buy them in an environment with low economic growth, low inflation. But since the pandemic, we haven't had that situation. So we're starting to see growth pick up, we're starting to see inflation pick up, and that is not an environment that you want to own these growth stocks in. Right? So in an environment with growth, with good economic growth, you don't need to pay so much for these high growth stocks, right? Because there's so many other companies, so many other industries that are growing when there's a lot of economic growth, particularly the sort of cyclical stocks, meaning the stocks that do really well when economies are doing well. So airlines and energy and financial, so banks. These are all the stocks that become pretty interesting to people during these times, not the growth stocks. But the other thing is inflation. When inflation is increasing, like we have now, you really don't want to own these growth stocks because, as I said, the way that people value these stocks is they say, what is the present value of all these future cash flows? And if there's inflation, then those future cash flows are worth a lot less now in the present because inflation eats away at those future cash flows. So you don't want to own these growth stocks when you have economic growth increasing and inflation increasing. And that's essentially what we've had for the past few months now. We've had a lot of data to show that we are expecting a lot more inflation going forward, which is a debatable topic, but it is what it is. People expect inflation. And that is how the market has been reacting. People have been, and the market has been expecting inflation. So whether or not that might be true long term is another question, and it's another topic for another video. But that's what the market's been saying: increased inflation and increased economic growth. And actually, I can show you some of the data that supports this. So here, this is the 10-year break-even inflation rate. This is basically what people expect inflation is going to be over the next 10 years. And it's usually around 2 to 2.5% ever since 2004. And it took a deep dive in the pandemic in March 2020 because economies were shut down. So it makes sense that inflation was expected to be low. But ever since, it's shot up, right? We've seen inflation expectations are going through the roof. Let me pull up a chart of the interest rate. So the 10-year interest rate, 10-year yield. So see, This is the 10-year government bond yield in the US, 10-year treasury yield. Bonds also don't work well in inflation because it's a similar idea, right? Bonds are a stream of cash flows that go out into the future until that bond matures. And so if we have inflation, those future cash flows are worth a lot less because, inflation eats away at them essentially. A bond also has a fixed yield or a fixed interest rate that you're making. And if it's 2%, and inflation goes higher than 2%, then you're essentially losing money. Your real rate, right? So the real rate is the interest rate minus inflation. And so if, let's say, your bond is paying you 2% a year and inflation is 3%, your real rate is -1. So you're losing 1% every year due to inflation. So that's why bonds don't work in inflation. And what we've been seeing is bonds have been selling off ever since March. So this is the 10-year government bond yield in the US. And the way it works is when bond yields go up, it means people are selling bonds. Ever since the pandemic, or I would say mainly since the end of November, bond yields have been going up quite fast. This past quarter, bond yields had the worst quarter on record since 1976. So they had a really bad quarter. Bonds sold off a lot because, as I said, there is this expectation of future inflation and future economic growth. That's the thing about bonds too, is that not only do they sell off when we expect inflation, but they also sell off when we expect future economic growth, strong future economic growth. Because in an environment where the economy is growing, why would you lock in your money in a bond that pays you, let's say, 2% interest when you can be investing into a growing economy? Basically, this environment is really deadly for bonds. The same way that it's really deadly for growth stocks, right? The economy is growing and inflation is going up. But getting back to the tech stocks, if I look at Tesla peaked roughly February 9th to February 10th. And what happened on February 9th or 10th? Well, that's when February 9th and 10th is essentially right here. But that's when interest rates, government bond yields, really started to shoot up past their previous highs in March 2020. So yields, ever since the pandemic started, yields were down quite a bit, and they were steady and they were slowly going up, but they hadn't really gone above this point that they reached in March, when they really sold off in March along with everything. Bonds were being sold as well as stocks. But on February 12th, pretty much the day of February 12th, that's when it shot up above that limit, and they've been going up ever since. And so that is the reason why all these stocks like Tesla and NIO and Palantir, I don't remember there we go, Palantir, why they all peaked essentially on February 12th, because interest rates really shot up to the upside. And so that's the environment that we're in. Today as well, we received some pretty good economic data about the jobs. So in the US, jobs are increasing ever since the pandemic, ever since the low, right? There was a huge loss in employment in the US. But ever since, it's been steadily increasing, right? And so today's number was further evidence that we're seeing stronger economic growth. We're seeing job creation. There's a lot of other clues that tell us that we are seeing good economic growth and increased inflation. So not only the real yields and inflation expectations and bonds, those are all signs that we're expecting higher growth and higher inflation, as well as growth. All those growth stocks are falling. That's another sign. There's quite a few more. We can look at sort of a basket of commodities, a broad basket of commodities. They've been going up, right, ever since March once again. And commodities now have been higher than they've been in a long time. Same thing with copper. The price of copper has been shooting up to the upside like crazy. And copper is a good indicator of the general level of economic growth, right? Especially world economic growth, because copper is used in it's used as a material in so many industries. It's used in houses. It's used in so many places. Copper is used in a lot of things. And so the price of copper has been shooting up. That's another sign that we're seeing a lot of good economic growth, as well as inflation. Not only that, but also we have really positive news, really positive manufacturing news. Here, manufacturing expanded in March at the fastest pace since 1983. Here's another sign of inflation increasing. Here we have US import prices. So they've been going up, right? There's some more signs, more indications of potential inflation. I spoke about commodities before, but it's another indication of future inflation and future growth. Commodities typically go through these long-term cycles, right? And we're at the bottom, or looks to be at the bottom of the next longer-term cycle. Here's residential investment and durable good consumption. A durable good is any product that doesn't wear out quickly. And so typical examples of these durable goods are appliances, home and office furnishings, cars, tools, semiconductors, stuff like that. So stuff that usually increases when growth is increasing, right? And what we've seen is that the sum of residential investment and durable good consumption has been going up. And this is what we see during these cycles, right? We have periods where economic growth is great, and so durable goods consumption and residential investments going up. And then it starts to slow, and then eventually gets into negative, so then we start to contract, so we start to go below 0% growth, and then typically that's when we're having a recession. And when we come out of a recession, this growth rate shoots back up. And so that's what we've been seeing since March. To get back to the beginning of the video, when I talked about these growth stocks, right, and how I believe it's not the environment to buy these growth stocks, I sort of laid out the evidence for you, essentially. We have an environment of increasing growth and increasing inflation. But not only that, I mentioned before how a lot of the reason why these growth stocks were performing so well was because people were gambling in the stock market. They had nothing to do at home, and so they were buying options in the stock market. And what we've seen recently is that in the past, when stimulus checks were announced, we saw a large increase in call option volume. So this here is sort of the net call buying. This is the number of contracts that are being bought on certain dates. And as you can see, whenever there's a stimulus check, or in the past, whenever there were stimulus checks, people were buying up call options, especially these sort of smaller accounts were buying up call options. We saw a lot of volume increase. Same thing in the second stimulus check. When that came, we saw call option volumes increase massively. But this latest stimulus check, so this third one that happened just a few weeks ago, we're not seeing the same behavior occur. We're seeing people now are not really gambling in the stock market as much as they were before. And so in an environment with increasing economic growth, increasing inflation, and less people gambling in the stock market, which was a major reason why these particular growth stocks outperformed so much in the first place. For those three main reasons, you should not be buying Tesla, NIO, Palantir, any of these growth stocks right now. Any bounce that occurs, so they've sold off a lot since February, and it's only natural for there to be some bounces. So if I look at Tesla, it's only natural that we would see maybe a short-term bounce in Tesla, but any short-term bounce should be sold. You should not be buying these stocks in this environment. And I hope I've laid it out pretty clear as to my reasons why I believe you shouldn't be owning these stocks, and why I think the people who are talking about these stocks on YouTube, and I don't know if they're talking about it on Wall Street Bets, but I saw a lot of it on YouTube, and it was quite concerning because, like I said, I don't think these stocks are going to perform well, and I think they could fall much, much further. So Tesla stock, it could fall another 50%. At the current valuation, even now, since it's fallen, let's say 25%. So Tesla 25% lower from the high in February. At that valuation, it still doesn't make sense as a company. Tesla doesn't sell that many cars. At one point, Tesla was valued higher than all the other car companies combined, right? It didn't make sense. And even 25% lower than that valuation doesn't make sense. So these stocks have potentially a lot lower to fall. And I think it could be risky to buy them at this point, because if you think they're going to be bouncing, once again, there might be a short-term bounce, but I think they might continue that downward trend. And in this case, the trend is your friend, right? Don't fight this downward trend. If the price reverses, and if all of a sudden Tesla and NIO start going up again, and the trend is really starting to reverse and go up, then okay, I'll admit that I was wrong, right? At the end of the day, price is the ultimate arbiter of truth. Price is what tells you if you're right or wrong. And I think anyone who is blindly pushing their viewers into these stocks, promising 8,000% gains, is not doing a good service to their viewers. And it's potentially risky behavior to be buying these stocks at this point in time. So I hope you guys enjoyed the video. As I said, I saw people talking about a lot of these stocks online, on YouTube especially, in the comments and in videos. And so I felt like I wanted to release a video to give my opinion on things and to give my warnings, I guess you could say, about these stocks, and how I think if you're buying these stocks now, you should be prepared to take some losses. Or at least if you're buying them, don't buy very much. Buy small amounts, make an initial bet, and if the price keeps going higher, then you can build out that position. Thank you guys for watching. Be sure to like and subscribe, and I'll see you guys in the next video. Take care.